Imagine for a second, what if your everyday money, the digital cash you use for bills or just keep handy, could actually earn you decent interest? Like way more than your bank gives you now.
Mm.
Sounds good, right? Well, that idea is actually at the center of a huge fight happening right now in Washington, D.C. A real regulatory battle shaping how your money might work very soon.
We're diving into stablecoins today, those cryptos pegged, usually, to the US dollar to keep their value steady. And the big question is, should they be allowed to pay interest?
Yeah, and it's fascinating because this isn't just some technical crypto debate. It's really a fundamental clash. You've got the old guard, the established banks, versus this new world of decentralized finance, or DeFi. And the outcome, it could seriously change things like loan rates, how banks operate, maybe even financial stability overall.
Absolutely. So our mission today is to really unpack this. We'll look at the arguments from the big banks, represented by groups like the Banking Policy Institute, and then the crypto industry side. We'll dig into this new law, the Genius Act, check out some potential loopholes people are talking about, and figure out what this whole tug of war means for you.
Right. We've looked at analysis from places like Cointelegraph, heard from legal experts on crypto policy folks like Andrew Russo, Aaron Broen, plus statements straight from the BPI, and key crypto players like Brian Armstrong and Jake Chervinsky. So yeah, we're trying to give you the full picture beyond just the headlines.
Okay, let's get into it.
Yeah.
Setting the stage. Stablecoins, the Genius Act, and the spark of contention. So first, just a quick level set. Stablecoins. They're digital currencies, but designed not to be volatile like Bitcoin. Usually they're tied one-to-one to something stable, like the US dollar. Think of it like digital cash on a blockchain, fast, transparent, efficient, but without those wild price swings. Basically, a digital dollar meant for everyday use.
Exactly. And because they've gotten so popular, the U.S. passed the Genius Act to, bring some rules and clarity to the space. It's a big step. But like with any new law, the real arguments start when you look closely at the wording. And here, it's all about this idea of interest-bearing stablecoins. That's the hotspot.
Yeah, this is where it gets really interesting and frankly why it matters to you listening. Can the companies issuing these stablecoins, or maybe crypto exchanges, pay you interest just for holding or using their digital dollars? Imagine your digital wallet earning a yield much higher than your savings account. That would be huge, wouldn't it? It completely changes the game for banks and financial services.
Oh, definitely. A potential game changer, too. The banking industry sounds the alarm. A threat to financial stability.
Okay, so leading the opposition here is the Banking Policy Institute, the BPI. Super powerful group, represents most major banks. Think JP Morgan's Jamie Dimon is involved. And they are not holding back. They've gone to Congress basically saying these interest-paying stablecoins are a major threat.
Yeah, they've written letters, made statements. Their main worry is a kind of domino effect. They think if lots of people pull their money out of regular bank accounts and put it into these stablecoins to chase higher interest, it could seriously mess with the whole credit system.
Right, and from their point of view, it makes sense. Customer deposits. That's the fuel for banks. They don't just let that money sit there. They lend it out, creating loans, credit lines. That's how a lot of money gets created in the economy. So if those deposits shrink, the BPI says it flat out, increase lending costs and reduce loans to businesses and consumer households.
Less money to lend means loans get more expensive or harder to get. That hits small businesses, people trying to buy homes, you name it.
And Andrew Russo, he's a policy attorney, looking at this, he kind of crystallizes their biggest fear, creating these unregulated shadow banks.
Right. His point is, if you let stablecoins pay interest without the same tough rules banks face, like capital requirements, reserve rules, strict oversight, you risk creating this parallel system. A system that could face liquidity problems like old school bank runs, putting users at risk and, maybe even threatening the stability of the whole financial system. It's a serious concern they're raising about safety and soundness.
And they're pointing fingers directly at a specific part of the Genius Act, Section 4A11. It says issuers can't pay interest solely in connection with the holding, use, or retention of the stablecoin. The banks hate that word solely. They think it's a massive loophole.
They want it tightened up, basically closed, because they think it allows these interest products to sneak through, creating exactly the risky system they're warning about. 3, the crypto industry's pushback and the porous prohibition.
Okay, but then you have the other side. The crypto world has wanted interest-bearing stablecoins for ages. People like Brian Armstrong at Coinbase argue it gives users more power, more control, and access to better yields than traditional banks often provide, frankly, because of their own regulations and business models. For them, it's about innovation, giving people better options.
Definitely. And this is where the legal interpretation gets really, really interesting. Broen, he runs a crypto-focused law firm, zeroes in on that exact word, solely. So he told Cointelegraph it's a powerful legal limiter. It means the ban isn't on all interest, just interest paid only for holding the stablecoin. Nothing else involved.
So what does that actually mean in practice? If it's not just for holding, it might be okay.
That's what Broen suggests. He thinks while the law looks comprehensive, that specific wording makes the interest ban probably actually relatively porous. Meaning, if an exchange or platform offers yield but ties it to something else, like maybe you have to lock up your stablecoins for 90 days, or participate in a lending protocol, or stake them somehow.
So if there's another condition, another reason for the payment besides just holding it passively.
Exactly. Then it might not be covered by the ban. It creates this potential pathway for yield generation that isn't solely based on holding. And that's precisely what the BPI is worried about, that potential workaround.
Okay, I see the nuance there.
And Russo adds another point, too. While he acknowledges the bank's stability concerns have some merit, you can't just dismiss them, he also suggests their claim that any issuer-paid interest is inherently dangerous might be going too far.
So maybe it could be done safely.
He implies that, yeah. With the right regulations in place, maybe strict reserve requirements for issuers like 100% backing or regular audits and stress tests similar to banks, perhaps interest could be allowed safely. Which kind of hints that maybe the bank's pushback is partly about protecting their turf from competition, not just about systemic risk. It's probably a mix of both, right?
Yeah, that makes sense. Protecting the existing model versus enabling innovation. It's the classic tension. 4. The unfolding battle. Will genius be amended? So the banks, they've got clout in D.C., no doubt about it. They've shaped laws before. You have to wonder, will they actually manage to get the Genius Act changed to close that solely loophole?
Well, Russo brings up how policymaking often works or doesn't work. He says when you have these really powerful groups fighting against each other, sometimes the result is just gridlock. Legislation gets watered down, regulations get fuzzy, and nobody's really happy. He even draws that parallel to the lead up to 2008.
Oh, right, the mortgage crisis.
Yeah, where mortgage lenders managed to block tougher rules, which, didn't end well. His point is these intense lobbying fights can make people lose faith in the government's ability to regulate fairly. It seems like someone always gets special treatment.
That's a heavy comparison. Thinking about 2008, it really makes you wonder if we're seeing a similar dynamic play out, just with different players and technologies.
It does make you think. But then again, some folks in crypto think the banks are tilting at windmills, as Jake Chervinsky from Variant put it.
Tilting at windmills, meaning fighting a losing battle.
Pretty much. Chervinsky's point is that the Genius Act already considered a lot of the bank's concerns when it was being written. So getting Congress to pass another major stablecoin bill right now, probably unlikely. He thinks that specific fight might already be settled, at least for this session of Congress.
And Broen, the lawyer we mentioned, seems to agree. He thinks the banks are kind of fighting against the tide of technological change here.
Yeah, he used that great analogy comparing it to music executives back in the day freaking out about Napster and MP3s. His argument is sharp.
Yeah.
People didn't love using banks just to make payments. It was just the only option they really had.
Right, you had to go through them.
Exactly. But now, with what he calls disintermediated finance, basically, finance cutting out the middleman, allowing direct peer-to-peer stuff, people don't have to rely solely on banks for everything. And often, the new ways are easier, faster, maybe cheaper. It's not just a small tweak. It's a fundamental shift. And banks are naturally resistant.
That music analogy really clicks. You can see how an established industry would struggle with that kind of a disruption. And the crypto industry itself has gotten much better at lobbying, at making its case in D.C.
Absolutely. They played a role in shaping genius. The power balance isn't as one-sided as it used to be. The real-world stakes. What does this mean for you?
Okay, so we have these huge forces clashing: banks, crypto, regulators. Let's bring it back down to earth. What does all this actually mean for you listening right now? Your savings, your business, your future plans?
Well, the BPI paints a pretty stark picture if things shift too quickly towards stablecoins. They warn directly about higher interest rates, fewer loans, and increased costs for Main Street businesses and households. So, if you run a small business needing credit or you're hoping to buy a house, their argument is that if banks lose deposits, borrowing could get tougher and more expensive for you. That's the potential downside they highlight.
Right. So this isn't just some abstract debate about financial plumbing. It's really about what kind of financial system we end up with. Will it be one with more innovative, maybe higher yield digital options? Or will the traditional system, prioritizing stability, maybe slower innovation, remain dominant? It directly impacts how you save, borrow, and pay for things every day.
Yeah, when you step back, the core tension is really striking, isn't it? It's innovation versus stability. On one side, you've got the promise of these potentially more efficient, accessible, higher yielding products, faster payments, maybe new ways to invest small amounts. And on the other side, you have these very real foundational concerns from the banks about protecting consumers, avoiding instability, keeping the existing system safe. It's a tough needle to thread.
Definitely. And it's super clear the Genius Act isn't the end of the story, not by a long shot. This whole conversation about stablecoins, interest, regulation, it's going to keep evolving as the tech and the market change.
Which leads to a really interesting question for you to think about. We've seen tech disrupt industries before, right? Music, taxis, whatever. And we see the strong arguments on both sides here. So how do you think our daily financial lives might change if this disintermediated finance thing really takes off? And maybe more importantly, what role should regulation play? Should it protect the old ways, boost the new ones, or try to find some middle ground that balances innovation with safety? Something definitely worth considering.
Absolutely. Well, thank you for joining us on this deep dive into stablecoins and the shifting sands of finance. We'll definitely keep an eye on how this all plays out.